Thank you all for coming to our final panel of Housing Washington, all about tackling increased insurance costs for affordable housing providers. We're going to have an extended panel conversation, but first kick off with some data presentation by Brynnan from Propel Insurance, and I'll let you take it away.
Thanks. Brynnan, make me happy. Okay, do my best. I don't know if I was set up for success or failure here with this being the last session at 4 o'clock in the afternoon about insurance. So this is, I'm happy to see so many people in the room. I wasn't so sure. So, but yeah, I'm Brynnan Hyland from Propel Insurance. We're a Pacific Northwest based insurance firm, and I see some familiar faces here. So I know some of you, but. Obviously, kind of the insurance has become really a four-letter word, more so than it traditionally has been, especially with affordable housing. So some of the things we're going to talk about today, broad range of topics. What I want to do is just kind of set the stage for where we are and give kind of some contextual background for how we got here and what's driving a lot of the issues that I think we've probably all experienced really in the last couple of years. This slide here will unfortunately probably look very familiar. This is what we talk about, the pricing increases that we're seeing on a monthly and quarterly basis going back really the last 18 months. So what I want you to kind of notice here is outside of the trend that is going up, if you look at the red shade on the top of those pillars there, that is the percentage of renewals that are coming in the 50% or more range. So if you look back historically, we can kind of see that is a relatively small selection of the renewal increases that we're seeing. What does that tell us is, mostly the portfolios that were having adverse loss activity or something that was driving the price up. Now we're really seeing that increase, those large increases kind of take place across the board, regardless of portfolio makeup or portfolio historic performance. So why is that? How did we get here? And then we'll dive into kind of deeper of what the ramifications are with the panel. But how did we get here? So a little bit of context about how insurance companies and the industry as a whole drive their pricing metrics. Most of these companies work off of, on the carrier side, work off of what's called a combined ratio, meaning for every dollar that they come in, between losses and expenses, how much are they making? What's their profit, right? So anything under 100 means they're turning a profit. Anything over 100 means that insurance company or the industry or that particular sector is losing money. So we're seeing money flow out. So you can see that we've really seen kind of a very historically, when insurance companies are doing well, they'll tell you they want to run somewhere in the mid to high 90s is profitable for them. We're seeing that really creep up and up and up. And if you look for the last 5 years, this only goes to 22, so we don't have full data yet for 23. You can see some of the drivers for the years that were poor, right? And you can see kind of a steady increase up in overall combined ratios. So what's driving the price increase is in order to combat kind of the declining profit environment for insurance companies is the rate increase that we're all feeling. So why is that? A lot of what we're talking about here when is property premiums. That's typically 90% or so of a portfolio's buy is on the property side. Some more heavily weighted to the liability. However, property is really the driver of most of our headaches. So when we talk about what's driving property rates up, this is what we call the catastrophic events. Think typically wildfires, hurricanes, large hail events, or freezing events. You'll see some noted here that the Texas freezes, a number of hurricanes. So these are large dollar events that happen in the industry that suck enormous amounts of premium dollars or lost dollars out in one event. So as you'll note there, between 1980 and 21, averaged about $23 billion a year. In the last decade, we've seen that double. So what does that do to kind of the availability of insurance dollars? It means that carriers are no longer willing to put forth premium or exposure dollars into the industry because they are not able to get the return that they once were. So what does that do? It really shrinks our supply of available insurance, both from a carrier standpoint and from a capacity standpoint. One thing we'll talk pretty heavily about, and I don't want to kind of bore you with the details before we even get started here, but is the reinsurance market. Now, kind of just ground level, what is reinsurance? It is the insurance that insurance companies go out and procure on their portfolios of insurance so that they can limit their exposure to these catastrophic events. We are seeing the pool of reinsurance, or the price for reinsurance, drastically increase while the supply is drastically decreased. So what does that mean? It means that your traditional insurance companies no longer have the backing that they once did to go out and take the risk that they previously had. So that allows them, or it forces them, to charge more for what they are willing to put out there, because they are no longer able to pass along the majority of that risk that historically they've been able to do. So we're going to talk in the panel about kind of some of the things that can be done to avoid this. Where do we go from here? How do we solve this problem? When we really boil it down, we have a supply problem or a capacity problem in the insurance marketplace right now. Not enough people are willing to take the risk to put up the capacity or the insurance dollars for the return on the investment that they can potentially make on that. It's no longer a winning proposition for them with the rate structures as they have historically been willing to price it at. So when we go back to that first slide and we talk about, okay, we're seeing double-digit year-over-year increases, what's driving that? It's insurance carriers and the reinsurance market trying to right-side their pricing indices from some of the events that we talk about when we talk about the catastrophic events, or on this slide, some of those large dollar claim events. So if that sets the stage for it, I think we can move to questions here, unless there's anything else you wanted to hit on. Yes?
Is a combined ratio being applied on a national basis or a regional basis?
It's on a national basis. So
So, for example, in some regions like this, we're paying for hurricanes and stuff, essentially. Is that right?
So let's yes. So if you look here, the Pacific Northwest is a little bit of a bubble in many ways, but specifically in the insurance world. So when we are essentially footing the bill for some of these other events that happen across the country. Obviously, you don't see a whole lot in the Pacific Northwest on this graphic. Now, that doesn't mean that the reinsurance carriers are more or less willing to deploy capacity here, so to speak. The increases that we think are bad, if we're talking about a coastal property in Florida, are totally different ballpark. So we are still in what's a preferred environment by a wide margin, even with some of the challenges that we're having. Yeah, let's
shift over to the panel discussion here.
Oh, sorry.
Real fast, what factors are driving that supply constraint on the reinsurance side?
Yeah, a lot of it is not the ability to no longer get the return on investment that if you're a reinsurance carrier and historically, let's say you'd be willing to take on $100 million of exposure, so to speak, and you could call it $1 million for that. Now, where because the combined ratio with the claims activity that we're seeing, the combined ratio is just kind of a factor of that. They have to essentially increase the price that they are charging for that unit of risk in order to attain a return that they think is palatable.
Let's shift over now to our panel. Most of our panelists are on this next slide, but we're gonna shut off that so Brynnan can actually see.
You look so good. And so do I. I thought I was like 7 years old. You look great. Your haircut's get based.
Thank you for that presentation. I think first thing for me that comes to mind is, why is this happening now? Why are we seeing the 30% increases happen this year? when with that catastrophic losses, we've seen those been ticking up over the last 5-10 years. Is this just a matter of unsustainable trends in terms of climate-related disasters catching up? What's going on?
Yeah, this is not the first year that unfortunately we've seen some of that rate activity. So it's probably been trending really the last 3 or 4 years, and this year it's compounding. One, it's compounding on top of the previous year's increases, and two, we're just seeing it continue as opposed to level off. I think that the insurance world, for better or for worse, moves very slowly at times from a reactionary standpoint. So you're seeing kind of a right siding of rate happen over time. So I don't think that this is the first year it's happened, but we're more acutely aware of it this year due to some of the pain that we've seen in the industry.
Yeah, it's certainly something that working in the housing sector, never heard about insurance up until about 6-7 months ago, and now it seems like everything that providers talk about. I'm a couple layers down from the operator standpoint, and so I do want to drill into those impacts. I guess here to a question to the providers, to Maiko, Winkler-Chin, like just who is affected by rising insurance costs and how? Can you put this into perspective?
Well, Jesse, you don't remember this because you were not working in housing after 9/11, when all of our insurance went up by like 50, 60%. It dropped after that after a few years. But that's also, if you remember looking at the chart of all the stuff, all the disasters, the climate change issues of the once in a lifetime storm became a once in a decade storm, became the annual storm. Like King 5 had to like change how they talked about it because winter storm became first winter storm and the fifth winter storm, right? So I think back 25 years ago when we saw big bump ups, maybe it dropped because you didn't have anything. But with the more frequent level of big superstorm this or superstorm that, the payouts have become more familiar. And so full disclosure, I've only been at the Office of Housing a year and a half. I used to work for a public development authority, and Propel was my insurance. And they told me like 8 years ago, girl, it's getting bad. It's going to get bad. Things are going to get wacky. We're going to have to do some things. So let me just say that. It is, I think, the cost of insurance and how it's impacting everybody. I don't know anybody that's in the Seattle market that's not being impacted. And before I was in this job, I remember talking with a variety of different agencies that were all a bunch of public development authorities, and we were all getting hit and becoming very, very nervous with the 30 to 50% increase. I have dollar figures from everybody who's done a table for those of you who know what that is. The challenge with that is I can only tell what you pay, but I do not know what are the accommodations people have had to make. So I know at my own agency, I think I went from a $5,000 deductible to a $50,000 deductible. And that is a pretty big increase, or higher than that. So the cost, yeah, I see Flo with her thumbs. She's giving me a thumbs up, and that's not like a yeah. It's a because of all that. I was talking just randomly today with somebody who is at a public housing authority, the executive director, and they told me that they're anticipating a 30% increase this year. I know in talking with somebody else at another housing organization, they did a 50% increase with a 30% increase. So it is something that's hitting everybody. I haven't really seen it in my home, my single family home personally. I do have a niece that's in California that just bought a home. She can't get insurance by State Farm or Allstate because they're not doing it. Because I think of some of the payouts for things in Los Angeles. She lives in the middle of Los Angeles, but you know, when you hear why people are pulling out, it's wildfires, rainstorms, potential earthquakes, all of that. So Jesse, I don't know if that answered your question. It is the bucket of doom, right? So
bucket of doom.
Yeah, we have had these sharp increases before. They have fixed themselves, but the conditions were very, very different 20 years ago, and I was a young woman.
I'm wondering if we can contextualize the cost of insurance to affordable housing providers a bit more. Like, what percentage of overall operating costs are we talking about when we're talking about insurance?
According to data
Yes.
that we have, they're roughly, typically insurance costs are roughly 5% of adjusted gross income as well as expenses. This has been increasing more as of 2020, so it is going up. It's gone up 12% over the past 17 years, 17%, and that's on average. But increases in deductibles are went from $10,000 to over $100,000 for deductibles. So in terms of percentage of actual rental income, oh geez, do you really want to know what this is? It's like up to, it looks like it's up to 17%. Sorry, 17.4% and much higher than that. Let's see. Yeah, let me go look over these numbers because I got a whole bunch of percentages and I do have my reading glasses on. Come back to me.
Tentative 17%.
I can answer anecdotally just in helping sponsors that are up for renewal. And a lot of times the first time it really hits us is, I don't own any rental housing. I'm not working for an owner. So as the consultant, I'm trying to help with the first year premium, quote as we place buildings in service. So, we do that, an estimate based on an operating budget when we go in for funding, the start of construction of a project. And that is usually based on whatever their last building's premium is in the year that we start funding applications. So 2 years later, when we are placing a building in service and going to get the real quote for the real building that's really being placed in service, I have in 5 different instances in the last year and a half encountered a double premium. So that's more than 17%. But I think that, and that doesn't take into account all of the other factors that you can do to get your premiums down if you do this or that or the other thing. But keep in mind that we are talking about brand new buildings that should be state of the art, that should have all of the sort of safety systems and warnings and features that one would have to protect an asset. So if that's happening to brand new buildings that are getting placed in service, I can only imagine that the increases, portfolio-wide to really old buildings that have very old building systems would be much worse.
I have those numbers for you. On average in 2022, the actual cost of insurance on average is 37.3% of the actual rental income. That's average, with a minimum of 1.3% and a maximum of over 5,000% higher than that. So the insurance cost per unit, it looks like on average is $610 cost per unit per annum, with the minimum being $62 and the maximum being $4,500.
If you think about what overall operating
variation.
costs are per unit, I would say that would be almost impossible, because when you think about overall operating costs per unit, I mean, in the room, folks would say, well, somewhere between 5,000 and 10,000 a unit is, depending if you're talking about supportive housing, maybe more than that, but.
39,000.
Thank you, 39,000. She says, do we get 30? We don't get 39,000 though, Maiko.
I don't care. That's the cost
Okay,
of
fine. It is the cost to operate. But so if you're talking about $600 of that being just the insurance premium, that's a pretty significant chunk.
Yeah.
So I think this is leading into my next question of what are the overall factors that insurance providers are considering when pricing that risk? Because that's a huge variation in the per unit cost. I think first to you, Brynnan.
Yeah, one thing I'll mention that we didn't talk about earlier is we have seen a real focus on the increased cost for reconstruction costs. So with maybe 5 years ago, 7 years ago, we could insure a building at, call it $100 a square foot from a reconstruction cost standpoint. Now that is, in most cases, well north of $200 per square foot. So what does that do? It means we've really doubled the value of an asset that we are insuring. So that compounds the rate increases that we're seeing. So that's another component that as buildings become more sophisticated and more expensive to, one, build, but two, rebuild and repair, and factor in labor, material costs, all of these things that, just like any other inflationary pressure applies to, it means that it costs a lot more today to rebuild or repair a building than it did 5 years ago. So that compounded with the rate increase is it's kind of a double whammy when you talk about the overall spend in insurance premiums. To your question, what are insurance companies concerned about, or what makes a building an attractive asset to insure? It's all of the things, mostly centered around building systems. Fire sprinklers, is it NFPA 13R versus NFPA 13? Meaning, is it a life safety fire suppression system or a preservation of property system? These are the granular details now that, again, 5 years ago, insurance companies would say, is it sprinkler, yes or no? Now they want details on that system. So it also, from a life safety standpoint, how many buildings are there? What are the ingress, egress means? We're being asked for blueprints now, where in the past we really haven't. So, most of the new construction is still very attractive as an asset from an insurance company. Anything that is really pre-2000, built pre-2000, has to see significant updates in those building systems, the HVAC, the electrical, the plumbing, the fire suppression, if it's there. We have seen a real focus on electrical systems. You probably have heard, hey, is there Zinsco panels or Stablock panels in your units? If the answer is yes, you're borderline uninsurable. So we're seeing carriers be kind of sticklers on those items. And if they are willing to extend terms, it's really on a short leash. Hey, you've got a year to fix this or something like that. So long-winded answer, but really there are a lot more underwriting data points now that go into a carrier being willing to insure an asset or a building. So anything from an update perspective, when you do it, track it. Sorry, go ahead.
No, I had a question about, so you've talked about this, but is there, I don't know if this is an uncomfortable question. Is there a question about tenancy, who's housing, or where you're located, and perceptions of crime?
Yes, 100%. So that's one of those data points. And it's less about the tenant population. What all these carriers will point to is crime score, which is kind of an indicator for them from a liability standpoint of things they're concerned about. So they're concerned about assault and battery, things of that nature. So yes, that's a metric that we've really seen kind of take off. And frankly, I don't think that the insurance companies yet have good enough data that they're using, so they apply it on more of a blanket basis versus a focused basis, which is, it's overly punitive, but it's a metric that they use to allow them to be punitive at times.
Yeah, on that point, just to say there are real factors that are part of a risk assessment, and then there are perceived factors that are driving an interpretation of risk for the affordable housing industry as a whole, and that's in the context of insurance bottoming out or having really massive challenges across the board and folks looking to affordable housing as a perceived higher risk. Some things that we've heard, one is on either perceptions of crime or actual crime. One is on perceptions of damage that occurs or actual damage. We hear nationally that there are insurance companies that are pricing relative to the number of Section 8 tenants that are in a building, which to me borders on a discriminatory vision of risk rather than an actual one. And I think all of this comes into play and then makes it more challenging for the industry. So it would be really good to better understand and parse out what are the determinations that are driving a characterization of risk and understanding where they're real and where they're more perceived.
Yeah, I wish I could give you more specifics on that, but I think the reality is that every carrier or even every, regional underwriting unit has different perceptions, and a lot of it is based on, their experience in an area or their perception of what is a risk, what makes an asset or whatever it is more or less risky. There is no one metric that we can point to. It is a little bit of a, not necessarily a guessing game, but there's no recipe, right? And there's no mechanism for accountability with some of these carriers to force them to adhere to a certain underwriting profile, so to speak, that holds them accountable for what could be seen as discriminatory practices.
Wow, we've got some interest popping off here. Please save your questions for the end. We will have like 10, 15 minutes to delve in. Lisa, do you want to say something there?
So as an operator, we're a public corporation, we're part of a government pool, so I don't think we've seen quite the same rate increases as a lot of the nonprofits. But I tell you, we've done it all. We've increased our deductibles to the extent that the lenders will allow. We've even had one come back and tell us, no, you got to go back down to 10,000. So we're buying down these policies every single year from a $50,000 policy down to either 25 or 10. So we're basically paying for insurance claims that we don't necessarily have just to get the policies in place that the lenders require. We're seeing impacts on the schedule of values going up because the replacement costs are so high. We're seeing the impact of insurance inspection telling us, hey, we're going to drop your coverage if you don't replace all of your electric panels in your entire building within the year. We're also seeing life safety health issues where we've had properties inspected by various different public funders, but then the insurance company comes in and says, oh, well, you've got gaps in your railing and you've got to replace the railing so that a head doesn't fit through. And so these are not just direct costs on the insurance. They're eating into our replacement reserves. They're eating into our operating cash. They're eating into the general building reserve funds for the buildings that don't have money to spend. It's hitting us across the board, and we've done pretty much everything we can to reduce the impact to the extent that the lenders will allow. So the only thing I can think of is increasing the deductibles anymore, but if the lenders would allow it, then we're still just going to have an impact on the replacement reserves or on the cash for the property. And that starts to really impact everybody.
Thanks for that, Lisa. That's why we wanted you on the panel. Grace, I'm wondering if you could respond a bit about how banks are handling this whole situation with rising insurance costs, how you all are responding.
Yeah, great questions. We are definitely seeing this across our portfolio. So Umpqua is not just in Washington, we're in Oregon, California, Idaho, parts of Nevada. We've been seeing this trend for definitely 3 or 4 years across urban as well as rural markets. It plays out differently project by project, but it's a pain point. We see this in terms of projects' abilities to meet perm conversion hurdles, right? When you're getting ready to stabilize a project, that debt service cover is a little bit harder to hit if insurance has double, triple digit increases over multiple years. We see it with ongoing debt service covenants after a project is stabilized, right? And we're seeing it in live construction deals where you just have to start really early to even get quotes or cobble together dozens of quotes to get to 1 or 2 viable structures that work for both lender and investor. So the most common request that we're seeing is higher deductibles, an increase in requests for higher deductibles for hazard and property insurance. Maiko's touched on this, Lisa's touched on it. The flip side is, you're really taking on more risk as an owner, right? So as a developer, you're self-insuring up to that deductible amount.
And so if I'm a developer and I've got a portfolio of, say, 50 properties, if 10 properties has an event and each of those has a 50,000 deductible, you know, what FTE do I have to give up to pay that? That's a big level of risk, right? So there's the hazard and property insurance side. A less common, but popping up more commonly, is a request to delay binding builder's risk insurance for construction loans. 6 months ago, I didn't really see this request in the Pacific Northwest. It would have been considered some sort of pink flag by our credit folks. But in the last 6 months, it's becoming much more common. For those of you who are not familiar with the structure, if you have a live construction deal, your lender and investor will require builder's risk insurance. Typically, that's needed by closing. If you work strategically with your broker and your lender and investor, sometimes there is a cost savings to delaying that builder's risk insurance until shortly before you go vertical. But my best advice, which feels very limited given the little mountain that we're all trying to climb together, is start those conversations early, right? Talk to your broker, get those options, but then don't forget your lender and investor. We are your loudest advocates within our financial organizations for these affordable housing projects. We want to see these done. But we also need to get those options that you and your broker have negotiated approved. So loop us in early.
Can I ask, as the lender or capital partner, are there things that make you more comfortable, or are there things that can be provided when the deductible conversation is happening that can be brought to your attention to make you more or less comfortable taking or allowing a higher deductible? Or having the underwriter be more comfortable with an increased deductible?
We take a very collaborative mindset to ensuring that affordable housing happens in our community. So I don't know that there are 5 specific metrics or a specific thing in your balance sheet that must be this minimum level. Suffice to say, we want to see these projects happen. Bring us your ideas. We'll float them as long as we can within reason, right?
This is on.
Yeah.
I might use that as an opportunity to make a segue about what we do to mitigate those risks, because, or even the perception of risk, because part of our opportunity here is to make sure that we continue to have affordable and accessible insurance coverage. That's how we're going to make sure that we continue to create more affordable housing. And is there a way to collectively help providers mitigate some of the risks that exist? Is there an opportunity to create a subsidy pool or something that can do a combination of things, but help organizations to solve for more minor rehab and maintenance needs that they have in their units, or to upgrade so that there are preventative measures for criminal activity, or those other mitigating factors that help it make it more possible to be a lower risk client on the insurance market?
There's a lot there, but I think the easy answer is yes. Anything that we can do, or any collective can do to increase or lower the risk potential for any one community or building or asset will be positive. Now, exactly what those steps are, I think, again, it depends. There's no one blanket answer. If you look at one thing we've really been recommending heavily is to have sprinkler guards on your sprinklers. I can't tell you the number of water damage claims we see because somebody accidentally kicked over a sprinkler or adjusted a sprinkler the wrong way, or You know, every hotel room you go into has a sign that says "Do not place hangers on sprinklers," and yet it happens all the time. We don't have those in affordable housing communities. So, but the flip side is there's a cost to that. You know, to go in and retrofit a building post-build, there's a significant cost to that. And I can't sit here and say, hey, if we do this, you're going to get X amount of discount from the insurance company. What I can say is it makes the risk overall much more attractive. But you know, if you're talking about a portfolio of, you know, even 2,000 units or 1,500 units or 20 units, there's a cost for everything that you do. And if you have an insurance carrier saying, hey, you know, we love to see the sprinkler covers on, but I need you to replace every electrical panel. There's a, we always talk, with underwriter speak, there is a, what would you really like to see versus what is reality. There's not unlimited money to do capital improvements, even if they are, you know, strongly recommended from a risk management standpoint, to improve the risk of the building. And at the end of the day, if you do everything you know, that we would like to see done, somebody can still, you know, throw a cigarette through a window and burn the building down. So insurance companies are still going to charge you a premium, even if you do everything right. I think there's a lot of hope in your question that yes, anything that you do to positively impact the way your asset performs is great. Is it going to significantly reduce insurance costs in the short term? Probably not likely, unfortunately.
With
Telling
that,
us to have less hope.
I was going to say,
Michelle?
with that really positive note, I'm on the other end of the spectrum to say, what is all this worry? Is there a way we can attack the worry and say, listen, that, you know, we can do everything that you want and you still may not guarantee that our premiums won't go up. And also, in the meantime, we won't be able to create any more affordable units. That burns my toast. It really does. I don't want to go down that path. I don't want to appease, you know, warriors, which I think that is the basic nature of a carrier, is just that worry. And I don't know if there's a way to say, let's isolate sort of let's get a group of carriers that we can educate or somehow kind of bring into the fold. I don't, you know, that also is folly, I'm sure. Flo is just saying, you're ridiculous, right? But it does feel like that's, you know, if we go all the way down that path and we get nothing out of this, I don't feel like we've gained anything here, so.
Maiko?
I think I would just ask, this is not Representative Alvarado sitting here. This is Emily with Enterprise. Okay, so just to be clear on that. But I do think that it's, I just want to be clear, right? But I do think, you know, I think if it's a climate change thing, we got to figure out how we're going to fix this. If it's other things, I think we do. And, you know, we can all sit around and like monku about it and all this, but I do think, I would kindly request that the state actually do a study on what are those things and then try to figure out a mitigating factor. I never want the private market to get out of insurance, I don't necessarily think, but is it this pool that kind of backstops? So I'd like to kindly request the state do that, Department of Commerce, just to try to figure this out. I think New York did it. So it's like other people did it. You can pick it up and borrow it and tweak it and see like how unique. Because I do think, as I look at Flo, your insurance issues are probably slightly different than Lisa, but we have to address all of it because if you were in the previous sessions today, we need all the housing all the time, all the places.
More housing, and this is threatening the production of housing down the line.
What's an issue? Yeah.
We've seen that, just a side note, in California's working on that right now, a state-backed
Take the
reinsurance.
microphone away, Justin. We'll just keep talking.
So it is something that is, you know, again, it's a slow-moving ship, but we're seeing signs of progress.
Let's shift over to audience questions, and I'll accept some comments given what this room is.
All right, as y'all know by now, I'm Flo. Hi. And I'm a little anxious because I have to take an emergency call for work shortly. But I think I'm the big loser here. Our deductible is $500,000 per incident. Yes, it doubled. And this is based on experience. Now, for better or for worse, Catholic Housing Services insurance is tied in with the Archdiocese, but it's not all what you think. We have floods, we have damages due to, largely to housing very, very ill people without the supports for them, without the external supports from mental health, from the police department, from the courts, from services, even our own services, people have huge challenges with that. So what is insurance, folks? It is collectivizing the risk. And who is the collective? It's all of us. So it's very much like health insurance. When health insurance was left completely to the private market, what happened? Lots and lots of people had no health insurance whatsoever. And they went without, and people suffered and died. Who could have had treatment? So President Obama fixed a lot of that by making the private insurance companies meet certain standards and making the states increase standards to where people had to have insurance that they could afford. We need to do the same thing with housing, or else we're going out of business.
Got a question. Brian?
I have a question.
Can I say one thing, Jesse?
Yeah.
I agree, and also, we need to make sure that you can have the operating costs to actually do the services that you need.
Thank you.
And that you have the behavioral health supports to actually do those services. And part of mitigation is fully funding housing so that we don't have to create a either false or real image of things that are not working well. We can make preventative mitigations and investments that do both help the buildings and the residents and the organizations and happen to have a secondary consequence of helping the insurance premiums as well.
Thank you.
Thanks, Emily. Totally agree.
I have a question about whatever happened to captive insurance opportunities. We actually were invited to have a private label captive insurance arrangement with one insurer because we had a favorable loss history and it worked well, but then they exited the market, and through no fault of our own because of their overall losses, we actually continued to have pretty good loss history. What happened to captive insurance?
It's still very much alive and well. Traditionally, we have seen captives used more so on the liability front and less so on the property front. There are still opportunities to put property in captive placements.
What's captive?
That was going to be my next
sounds
comment.
scary.
It's like private reinsurance.
Yeah, essentially a captive is you buy into or you create essentially your own insurance company. And it can be administered by a third party where you are part of a captive with like-kind entities or a diverse selection of entities. The reason sometimes property as a driver of a captive struggles is because really captives are designed to self-insure that first $1 million. Now, from a property insurance standpoint, that first $1 million, that burn layer, removing that or taking that as a deductible doesn't substantially reduce the overall risk that, say, an underwriter is taking by taking on a large portfolio. So, without getting too far down the captive rabbit hole, it's still very much the industry is there. Again, I would say it's mostly geared towards heavier liability placements with a touch of property, but it has yet to be really used to take a large chunk of the pressure off the property market at this time.
Oof. A lot of questions. Okay. I'll go to you first.
Thanks.
And maybe let's start a lineup here.
Yeah, thank you so much for this super informative panel. I really appreciated your framing it in the larger national context. I guess my question is, in the context of these insurance dramatic increases in premiums, what percentage of that is due to this national picture, and what percentage of that is due to like more controllable factors around local risk and claims? Because I want to know where we can try to push the dial, right? If we can only affect 10% of that cost by our local, like what we can have some control over, maybe we need to be doing that, plus looking at the bigger picture of how do we separate ourselves from the more national risk pool, which is costing us all a ton? That's one question. Second question is, where does this end? You know, like if insurance just keeps going up and up and up and up, pretty soon nobody's going to be able to afford it. That's going to hurt the insurance companies. It's going to hurt the affordable housing market. It's like, where are we going with this? It just seems like untenable to continue. So hope you guys can answer that. Thanks.
That's you, Brynnan.
Probably talk about that for another hour. Oh, sorry. Try that. I don't know.
It's a little volume.
I can trade you mics.
Oh, there it is. There it is.
Okay. So, for your second question first, where does this end? I think that at some point we will come to a tipping point. Now, kind of the broader question there is, can insurance outrun climate change? The answer is probably no in the long run. Is there some semblance of pressure or some alternative insurance function, whether it be governmentally or collectively with association-driven buying groups, et cetera, that can come in? And I talked a lot about capacity and the short supply of capacity. That can take some of the capacity concerns away. I think that in order for us to kind of substantially stop the slide that we've seen, there likely has to be some kind of third-party intervention, again, be that a government agency or some kind of alternative risk pool that takes some pressure off of the standard market. If it's state or federal backed reinsurance that private companies have the ability to purchase and to buy into, to transfer some of their back end risk, there will likely have to be some kind of third party intervention because I don't think we're outrunning climate change. I mean, in the framework of this discussion, or probably any other. But your first question, I'm sorry, remind me.
What percentage of the rate increases
Yes,
are
yeah.
relatable to the national
Yeah.
investor versus our
So there's two things there when you talk about like an environmental or geographic factors. One is every portfolio or every operator kind of has, while they have a similar risk profile, there's different loss history. There are different managerial pluses or minuses that underwriters will take into account when they're kind of assessing the risk of a portfolio or of an operation. So that's obviously directly controllable, in-house. Now zoom out a little bit more, so geographically, what can we do locally? We don't have some of the catastrophic exposures that, say, a Florida or even California with the wildfires do. I don't think there's any one thing that we can do, like environmentally or geographically, that's going to drastically take pressure off of the insurance market. I think that if you do things in-house, like look to mitigate water damage, look to mitigate fire damage, kind of all of those large dollar events, that will likely have more of a long-term impact than changing something substantially kind of within the geographic region, because really right now, we're very lucky in the Pacific Northwest that we don't have some of these other exposures that we're seeing. If you look at operators in Florida or California or New York, where they have some of these, they're more acutely aware or affected by some of these. The ability to purchase insurance really at all is challenged. So it's hard to believe that we almost have it good.
Can I reframe this question in a way that I think is more understandable outside like insurance? I was like, if there were an insurance company that were just operating Pacific Northwest, guess like how much, or just Western Washington, like how much would we have seen premiums increase over the last year? Sure. Just the.
Lake Oswego had those really bad fires 2 years ago. Right? There's slides.
We did have an earthquake.
Sure.
Well, and if you read about the Cascadia.
Yeah, let's not talk about that.
Jesse, I'm going to reframe and reframe. I have a historical rookie question. Maiko mentioned that after 9/11, insurance went up a crazy amount. I don't like we're seeing now.
And let's be clear, 9/11 was also the same year that we had the Nisqually quake.
Yeah.
So
Yeah.
it was all kind of that.
But you remember it coming down after a few years.
I do.
Do we have any insights, insurance-wise, into what drove that trend? I don't know if your memory goes that far back.
Yeah, no.
The schedule of values was different too. I think we had a different type of economy.
We had a different type of economy than the bubble burst in the tech market, so values of real estate kind of had a different impact. So instead of having the perfect storm, we had a little bit of a softening of the market that impacted, I think, the rate increase.
And inflation's a little bit better.
We didn't continue to have 9/11s every year either. So.
What's terrorism insurance now on certain property?
Yeah.
Especially,
Dude, I'm losing the stack here, but I think you've had your hand for a bit.
Thanks so much for all of this. Just really quickly, you mentioned New York and California. Maybe there's some legislative considerations. Any other legislative fixes you see that we might look to research or follow?
I'll mention that Oregon just established a mitigation fund that's kind of this concept of having a public fund that you can bill the lower dollar amount repairs and maintenance needs to, so that buildings and property owners less have to turn to insurance for that. So they're standing that up now, and that's something we can look at.
It's tied to PSH.
Theirs is specifically tied to permanent supportive housing, you're right, yeah.
Hi, Erica Munoz with Tacoma Housing Authority. So we received a notice of non-renewal through Philadelphia, and we're out to market right now. So we've been doing a lot of risk mitigation factors, but there's a lack of funding. On top of that, we had a $3.4 million loss at one of our 2-year-old buildings this year. So we're like, we lose coverage November 1st. We're kind of panicking. They've pieced apart all our policies, and so I guess it's more of a frustration. How do we find funding for these risk mitigation factors? We had that major loss was a standpipe one of our tenants opened, and so we've gotten a state farm grant that we were able to get Knox locks for all of our standpipes, but then like the sprinkler head cages, various factors, mitigation factors, we can't pull together the funding, but then we're putting funding out towards higher premiums and higher deductibles. So I guess we're just looking for creative ways to mitigate risk ongoing.
Well, my insurance canceled November 23rd, so.
I happen to know a development consultant. Recap your portfolio.
I think she's talking about drains in every unit.
I mean, I would just offer that I have no response to immediately helping address this issue, and yet what we see is another instance in which, if we all get together and have collective advocacy around the type of investments and mitigation that's necessary to sustain the affordable housing portfolio and keep us on a path of being able to do more, that sounds like a very good advocacy plan.
Yeah,
That's what this is.
We had the same notice last year from the same insurance company, Philadelphia, and it was, we're not going to do affordable anymore. Now, how many companies are saying we're not doing affordable, and what's the reason behind that?
That's a good question. So just kind of on a blanket statement, in the state of Washington, if an insurance company wants to raise your rates more than, I believe it's 20%, they have to send you a notice of non-renewal or a conditional renewal notice. So a lot of what you see when you see a renewal, a non-renewal notice or a conditional notice is them essentially reserving the right to do whatever they want with your rates within kind of the allowable statutes of the Insurance Commission. So all that to be said, sometimes a non-renewal is not a non-renewal. It's your rates are going way up. To your question, what's driving carriers out of the affordable space? Affordable housing is not a blanket term to an insurance company. They look at, LIHTC or Section 42 in a different way that some of them underwrite Section 8. So there are all of these kind of broad spectrums that insurance companies use that how they drive their appetite. Now, why is that? Ask every chief underwriting officer of every insurance company. They'll have a different answer for why they like something, why they don't. It's kind of a subjective matter of what they like or don't like. All that being said, we are seeing some of the same carriers that are getting off market rate accounts or that vertical get off affordable. So I think that it is less a function of the affordable housing component of it for some of these traditional affordable housing carriers, and more of a function of their broad appetite within the property market as a whole.
I noted in the chat, but I think it's helpful to ask, can you share what's happening in other sectors? Like, I'm thinking hospitals, schools, there's just a ton of other places that should be hitting a lot of the same issues.
Yes, they are. So I think framing kind of, like, if you look at a hospital system portfolio, and this may get a little granular, frame construction is seen as kind of the most risky class of property right now. So a hospital, as an example, likely doesn't have a large schedule or portfolio of frame construction. So type of asset, construction type, makeup of portfolio, et cetera, has a large impact. Now, that being said, they are still taking increases, and that's kind of a comment on property. Now, I think where you see hospitals, as an example, take a large increases on the liability. You probably heard the term social inflation from a claim standpoint, meaning that a claim 5 years ago that would have been, call it $100,000, is now $1 million claim. So on the liability side, hospital systems, schools, some of these more publicly funded institutions are seeing much higher verdicts or payouts, driving insurance costs on the liability side.
We're almost at time. Okay.
Okay, it won't be long. Hi everyone, I'm Whitney Joy Howard. I work for the Aging and Long-Term Support Administration. We have state-funded housing subsidies, and we're looking to, we partner, we need immediate tangible physical housing. So we partner with developers, housing entities to use our subsidies. We're preparing a request for proposal to basically enter into master leasing to pay folks chunks of money that you can use for whatever you need to use to help with risk mitigation, and then subletting to our long-term care clients. So I just want to flag that because we're going to be putting out some sessions when we create our RFP in the upcoming couple of months to get feedback. So I would love it if folks had any input. I think that would be one way to be able to put some of those costs towards insurance, and how much costs would be needed and things like that per person. So I have a very big coat on. If you are going to the reception and you want to talk more about that, I'd love to chat with people. Emily, you're also my representative, and I love you.
All right, with that, all right, last word.
Are we done?
We can almost drift out.
It's just a quick question. Is anybody considered or thinking about just buying renters insurance for their residents as a reinsurance issue against your own P&L claim? Oh, fantastic.
I have heard that idea spouted off by a few different developers, but have not seen it stick against the wall. I'd love to see that explored more.
And how do we deal with it? so you went out and got renter's insurance.
You went out and got renter's insurance. I'd be curious to see how the other insurance providers would deal with impact that, but I don't know how we as a public funder would view that. Like, as long as I guess it meets our minimum requirements that we already have of our properties.
You carry both insurances, but you get the renter's insurance just because, you know, insurance companies are reducing what we can claim on our losses for water damage. So now we're up to $35,000. I'm sorry, $35,000 doesn't get me far in a fix. So how do we bridge that gap without going up with higher deductibles?
So with renter's insurance, I've heard this idea floated before, and even when we do have residents with renter's insurance, we've had a difficult time compelling them to make a claim. And so my question is, if we pay for the insurance, can we make a claim on their behalf, or will we still be taking the risk, and then them basically telling us, no, we really don't want to make a claim? So would it solve the problem? What's the risk in it?
Yeah, I think to your point, almost using renter's insurance as a deductible supplement is, I don't believe you can compel a holder of that insurance to file a claim. I mean, typically it is in their best interest to do so. However, I don't believe that the institution can hold any rights over that policy if they're essentially supplementing it but assigning the rights of it to the tenant.
There is a renter's liability type product.
Yes.
You control it as the owner, and it integrates with all of your property management systems. So as long as there's a tenant occupying it, and they can be found at fault. But that's, so the problem there is that a lot of times it's not a tenant fault. Not they hang a hanger on a sprinkler, but a lot of times it's just a natural fire. You can't pin it on someone.
Right, and it's an additional cost, obviously, and when we talk about, so market rate apartments oftentimes or all the time require tenants insurance, right? When we talk about an affordable housing operator, that ability to mandate that is obviously limited at times. So it would have to be a cost incurred by the housing provider, which again is, it's more insurance dollars.
And if we mandate it, we have to include that in the utility allowance.
Well, I didn't think we would have to cut off a riveting insurance discussion, but we are a few minutes over time. I hope everyone can continue the conversation and the reception. Let's give a round of applause to our panel. Thank you all for coming.